Welcome to our LBRC classes, and we are dealing with the subject of indirect taxes, in particular GST. So students, till now, we were discussing the provisions which are particular to domestic transactions. Today, we are going to deal with the impact of GST on international transactions. Now, here we need to understand that when we talk about international transaction, you already have a specialized law in the form of customs, which deals with international transactions, which we also refer to as import and export. But having said that, it is also important to keep in mind that what customs law deal with is basically only the import export of goods. Point number one. Point number two, the customs law is limited only to the imposition of duties which form part of customs duty, plus duties which are leviable under other laws, which also includes our GST, where the customs law through the Customs Tariff Act is also levying the IGST, which is applicable. But you should keep in mind one thing, students, that all this is limited only to transactions of goods. So when we talk about import, it is limited to import of goods. When we talk about exports, we are only limiting ourselves to export of goods. This is when we are talking from the customs perspective. But when we talk about GST, in that particular case, GST covers all transactions, which is goods or service. Now, in this particular case, where it is import-export of goods, over there, no problem. Even customs has a domain. In fact, in GST, we are borrowing the definitions from customs. In this particular case, we will be referring to customs definition only, but that is where we are talking about transactions for goods. But where we talk about transactions for services, interestingly, friends, customs law is not catering to import export of services. So over there, our entire deliberation discussion relating to import export of services will be only covered by the GST law and will have no relevance from the customs. So let me start with some basics with whatever discussion we had. So we are today going to discuss the import-export provisions, but from the GST lens. Now, GST, as we all know, is a transaction tax. It is levied on independent transaction. And it is also to be noted that GST will be applicable on both imports and exports, plus it will be applicable on goods and services both. Now a question will come, ki how come GST is covering transactions of goods, services, import, export? Why? So the reason is, as you can see, to provide a level playing field even to domestic suppliers vis-a-vis international suppliers when it comes to import. So let us say if you are procuring any service internally, or if you are procuring any goods internally. When I say internally, I mean within India, which is also called as domestic. So over there, those goods and services are levied with our local taxes, correct? Now, if there is no GST component on this import, then the problem would be that local goods may become costly as compared to international goods, because international goods will have no bearing of local taxes, whereas whatever you procure locally will bear the burden of local taxes, that is GST. So in this particular case, the lawmaker in their correct wisdom, have even curated international transactions in the GST law. Similarly, when it comes to export, in order to make exports competitive, we are covering it under GST so that whatever taxes you have paid on the inward side. So let us say you are an exporter. For exporting your goods and service, you have procured lot many things on your inward side, which would be GST paid. Now that is getting added to your cost if I'm not covering the export side of GST, export side under the GST. So what we are doing, we are covering the export side under GST, but you will see further, we are not taxing it. Rather, we are covering it so that we can allow you to encash the refund on your inward side taxes. Now, when we talk about imports, so imports of goods or services, both, when we talk from the GST lens, you have to remember that under GST, it is always to be considered as an interstate supply, and this is right from Constitution. So even when you read Constitution, Article 246A, 269A, all these, when they refer to import, there itself it is said it is covered under the integrated tax. And hence, under GST, the law applicable is IGST, the tax applicable is IGST, and it shall be categorized always as an interstate supply. So there will be no consideration of what would be the nature, it will always be interstate. Now coming to what is import under GST. So when we go to the definition of import of goods, again, as I said, that will be similar to what you find in customs law. But right now, what we are trying to understand is, before we go to the definition, we are trying to understand the tax implications. So as far as imports are concerned, when it is import of goods, the importer in India will be paying IGST. Now, importantly, students, you have to keep in mind, this IGST is paid through the customs law. That is when you are paying, the importer is paying customs duty. So alongside the basic custom duty, the Customs Act, read with the Customs Tariff Act, empower the custom officer to even collect the GST, that is the IGST component. In this particular case, you have to remember this, that import of goods and import of service, both being interstate supply, both leviable to IGST, is there is a one difference. What is that difference? The difference is that in case of import of service, it is taxable again to the importer, but with a difference that the importer is liable to pay that tax under 9(3), that is under RCA. Whereas when it comes to import of goods, the importer is liable to pay tax not under 9(3) or 5(3), but under 5(1), that also under the proviso of 5(1), which says that it is the customs law through which you will be paying IGST. So this is how there is an interesting differentiation when we talk about import and export, import of goods and import of services. Now here there is an exception. If there is import of OIDER services by an unregistered non-taxable recipient, so let us say you or me are taking a subscription of Netflix or of any such online subscriptions where the supplier is outside. In that particular case, the tax would be payable by the supplier himself. But this is only when you and me, who are unregistered non-taxable recipients under the GST law, if we are taking import of OIDER services, then there is a specific provision under the IGST law which makes the supplier of the OIDER service, who is sitting outside India, liable to pay tax. So this becomes an exception to the import of service RCM provisions. Other than this, all other import of services will be leviable to tax under the RCM. Now, let us proceed with the import side in more detail. So when we talk about import side, first is import of goods. Now, in case of import of goods, obviously the location of supplier is outside India. The place of supply of imported goods is the location of the importer. This is as per section 11 of the IGST Act. But in case of import of goods, the place of supply will be location of importer. Now here students, I would like to draw your attention to one important point. It is not the location of import. It is the location of importer. Now somebody of you may say, sir, what is the difference? So I'll give you an example. I am a businessman registered in Bhopal, which is falling in MP state. Now I order some goods which are coming from UK. These goods would be landing at our Mumbai port because that is the port where the ship would be reaching and the goods would be unloaded. Now, interestingly, even though the goods may be cleared at the Bombay port, even though they are landing at the Bombay port, even though they are imported at the Bombay port, but since the importer who is a registered business is from MP, the place of supply of this import of goods would be MP, even though the goods have landed at Bombay port and are cleared there. The reason for this, students, is that in case if we would have treated the location of import, that is the landing of goods, as the place of supply, in my example it would have become Bombay, that is Maharashtra, and then the buyer or the importer sitting in MP would not have got the ITC of this particular import. So in order that the ITC is easily fungible, it is transferred or available to the importer sitting in MP Bhopal. Hence, the law is so drafted to make the importer of the goods as the place of supply, the location of importer as the place of supply, and not the place of import. Now, importantly, what will be levied on this import of goods is firstly different types of customs duty and obviously from GST, the IGST. Now, there was a confusion that when this IGST is levied, if you read section 5(1) proviso of the IGST Act, it says that for the purpose of import of goods, you will refer the Customs Act for the purpose of its levy, its time of supply, its valuation, everything. And then Customs Act refers you to Customs Tariff Act, where under section 3 of the Customs Tariff Act, you are asked to pay IGST. Now, when we read this chain of provisions, a question comes that since we are paying the IGST as per the customs law, both Customs Act and the Customs Tariff Act, so can we say that IGST is a customs duty? So the answer is no. IGST remains IGST. The only difference is we have shifted the recovery provisions, that is the provision of collecting the duty, to the Customs Act. So in order that there is a single window recovery of all taxes at the time of import, which includes the basic customs duty, the customs cess, and the additional customs duty, the protective duties, and IGST at one place, so that it is even easy for the importer, plus it is easy for the government to administer and check whether or not correct duties are paid. So keeping in mind all this, only for convenience sake, for the sake of administrative convenience, the collection is shifted to the customs provision, and section 5(1) proviso of the IGST Act says that all provisions of Customs Acts shall apply, including levy, collection, valuation, time of supply, everything. Right? Now, if we go to the genesis of IGST on import of goods, it is levied under section 5 of the IGST Act, which is the charging section. But the ultimate levy and collection is shifted to the Customs Act by 5(1) proviso. Then it is levied in addition to the other customs duty. So this is not a substitution for custom duty. Also, this IGST is not to be treated as custom duty. It always remains IGST. Only the entire levy collection is shifted to customs. Then it will be leviable at such rate as is levied under the IGST Act on like articles if they are supplied in India. So for rate, again, you come back to the IGST Act, you come back to the respective rate schedule. So whatever will be the rate of IGST, If similar goods are supplied in India, the same rate applies for import. So in short, import or the customs law do not provide a separate IGST rate schedule. It will be the same as IGST applicable domestically. Why? Because again, the duty always remains a GST and does not changes to customs duty. Only the collection mechanism is shifted to customs. Now the question comes ki at what point in time will this IGST be levied and collected from the importer? So for this purpose, as I was saying, Section 5, subsection 1 proviso of the IGST Act has shifted this entire mechanism of the time of levy, collection, everything to customs. Hence, so the point when the duties of customs are levied, when they are collected at the same point of time, IGST will also be levied and collected. And what is this time? When we study the customs law, you'll find that it is the time of filing of bill of entry or the entry inwards, whichever is later. Now, an important point. What will be the value for the purpose of computing this IGST on imported goods? Here again, students, you should keep in mind Section 5(1) proviso of the IGST Act says that levy, collection, valuation, everything will be as per the customs. So here you will not apply Section 15 of the CGST Act, which is the valuation section of GST. Rather, you will apply Section 14 of the Customs Act, read with the customs valuation rule. Now, when you read Section 14 of the Customs Act, the value to be considered read with Section 3 of the Customs Tariff Act will be first the assessable value as determined under Section 14 of the Customs Law. So you first find out what will be assessable value as per Section 14, and for this purpose you also refer to the custom valuation rule. In that you will add the basic custom duty, plus if there is any other amount which is leviable under any other law for the time being in force. So all those amounts are to be added, if any. And if the GST component is already included in the value, you'll subtract it because we always want the value before GST. But what is important to be noted in case of imported goods is the basic custom duty and other similar duties which are levied under customs are all to be included in the customs value. So you determine the value as per customs, which is as per Section 14 of the Customs Act, read with custom valuation rules. And this value plus basic duty plus other duties, this becomes your total assessable value on which you multiply the IGST. Now comes a second situation. Now all this is part of the customs law. But since levy collection of IGST on imported goods is as per customs law, so it becomes relevant here also. Now, what if when the goods are imported, at the same time, the importer does not want to clear them? Then what does the importer says? The importer says that let these goods be with the customs, that is, let the goods be warehoused as per the custom warehousing provisions in the custom bonded warehouses, and at a future date, I will collect these goods from the customs. Now for this, the customs law has made express provisions which says that whenever you are going to deposit the goods in the customs warehouse, it will not be treated as a clearance. So your goods landed at the Bombay port. From there, you got the goods deposited in custom bonded warehouse, which may be within your city limits. Still, as per customs law, there is no consumption, there is no clearance, and hence the customs duty is deferred. Now, in this particular case, whenever you clear the goods from this custom warehouse using again the second bill of entry, which will be called as X bond bill of entry, when this X bond bill of entry is filed and using this X bond bill of entry, you get the goods cleared. Then comes the time when the IGST is levied. So since IGST is to be levied and collected along with customs or in the same manner as customs, so in case of warehouse goods, the IGST is also deferred. It will be collected at the time when goods are cleared from the custom bonded warehouse. Now here comes, students, a very important point. What if while the time these goods are lying in the custom bonded warehouse, I as an importer sell these goods to you and you are also not clearing it immediately? You want the goods to be in the warehouse and you will clear it at a later date. In short, what I am clearing is, sorry, not clearing, what I am supplying is the goods which are lying in custom bonded warehouse. Now comes the interesting provision. See, students, you should understand any subject, especially a taxation subject, by the governing provisions and the logic behind those governing provisions, if any. Now, if you understand this logic, what I'm going to explain, further many things will be very easy for you to understand. What is the logic? I just explained you that under customs, whenever goods are, let us say in my example, imported at the Bombay port, but you are not clearing it, you are asking the customs through the mechanism of your bill of entry that you do not want to clear the goods immediately. Rather, you want that these goods be shifted to custom bonded warehouse, which may be in Bhopal near your factory. But still, in this case, as per the customs law, the goods are still not cleared. Still, the import of these goods is not complete. In other words, if I have to give you an analogy, in the eyes of customs, the goods are still foreign goods. They have not yet been part of Indian goods because you have not yet cleared them because they are still lying with the customs. Now, once you understand this point, that goods which are being deposited in custom bonded warehouse and till the time they are in custom bonded warehouse and not yet cleared by the importer for home consumption, the goods remain to be treated as foreign goods and not goods which are part of India. Now, while these goods are in custom bonded warehouse, if at that time you transfer, you sell, you supply these goods to another person, interestingly, in the eyes of the GST law, it is like you are selling goods from one foreign country to another foreign country without the goods being cleared in India. And since this is how the customs law and the GST law are looking at it, hence the final implication under the GST law, the logic is that since you are dealing with foreign goods which are in foreign land, this is what is the assumption, this is what is the analogy. So you are dealing with goods which are in foreign land, hence our domestic taxes cannot apply. And that is why whenever goods which are kept in warehouse are supplied by any person before clearing it for home consumption, the GST law says we will treat it neither as supply of goods nor as supply of service. That is, it would be treated as a Schedule 3 transaction. And the moment it is treated as a Schedule 3 transaction, we all know there will be no GST implication. It becomes a no supply transaction. Now, having said this, another question comes is that when we are referring to section 17 of the CGST Act, if you remember, students, 17 subsection 2 of the CGST Act says that if your outward supply has both taxable as well as exempt goods, in that particular case, you will be required to do proportionate reversal of your credit to the extent of your exempt supplies. Now here the question comes that when these goods which are warehouse, which are lying in your bonded warehouse, when they will be sold, we all have seen that it is treated as a no supply transaction. So what will be the treatment? So it says that the value of such in bond sales will not be included in the value of exempt supply for the purpose of reversal of ITC under Rule 42 and 43. Correct? Next, when ex-bond bill of entry is filed for clearance, such warehouse goods, then what will happen? So now you are clearing the warehouse goods. So you had kept the goods in warehouse. We all discussed just now till the goods are in warehouse, they are not treated as cleared. And since they are not treated as cleared, hence there is no GST implication, right? Now what will happen when these are cleared? Just a minute. Now, when you will clear these goods from the warehouse by filing the second bill of entry, which is also called as X bond bill of entry, now what will be the implication? Now, in the eyes of customs, the goods would be treated as cleared goods. And whenever you are clearing the goods, you pay customs duty and alongside you pay IGST. Now comes the question on what value. Now, when you are talking about the basic custom duty, it is computed on the value which is determined under section 14 of the Customs Act. That is the value at the time of filing of into bond bill of entry. Now this is for computing basic custom duty. What about the IGST? For the purpose of computing IGST, now the customs law says you will take higher of these two values. The first is the value which we studied above also, which is the value at the time of import, which is the assessable value under 14 of Customs Act, plus basic custom duty, plus other duties which are levied under the customs. On this total, you will pay IGST, or on the transaction or sale value, whichever is higher. Now, when this is applicable, when you are supplying the warehouse goods further. So the goods which are lying in warehouse, you are further supplying it. Now, whenever these goods will be cleared at a later date, the value on which the IGST would be applicable is the higher of these two values. Next, student, comes taxability of high C sales. Now, what are high C sales? Again, students, high C sales means the sales where the goods have not yet reached the Indian port. So let us say same example. I am importing goods from UK. The goods are still in the sea. They have not yet touched our Indian waters and Indian port. Such goods are said to be in high seas. Now, when these goods are still in the transit, that is in high seas, some person approaches me for buying these goods. Now I have two options. Option one, I will say, okay, boss, wait for another 15 days. The goods are in transit. Let them reach Indian port. I will clear them from customs and then I'll give it to you. He says, no problem. You sell it to me today itself. I'll go and do the clearance. Now, this is where an interesting scenario comes. Today, if I'm selling the goods to this person, I am selling to the person what I'm not having in my hands today. The goods are still in transit, but still I can sell the goods today. This is called as high sea sales. So while the goods are still in transit, they are still in the high seas, I am selling it to another person. And this sale obviously is done by me before these goods are cleared by me. Now, in such cases, again the GST law says, since you are dealing with foreign goods which are outside India, hence it will be treated neither as supply of goods nor as supply of service, again as per Schedule 3. Further, the value of such high C sale, which is a Schedule 3 transaction now, is not to be included in the value of exempt supply for the purpose of your ITC reversal under Rule 4243. Next, when the bill of entry is filed for the imported goods, now who is filing the bill of entry? This bill of entry is be filed by that person who has purchased the goods from me under high C sale. So I have already sold the goods today. Now, after 15 days, when the goods reach India, the buyer who had purchased these goods will now go and get the goods cleared. Now again, the buyer will be paying customs duty and also the IGST. On what price? Both the taxes. Custom duty will be calculated on the price paid by the last high C sale buyer who files the bill of entry. So the buyer who is filing the bill of entry, the price at which that buyer has purchased. So in this case, I have sold to that buyer. So when that buyer is filing bill of entry, that buyer will be required to pay the GST plus the basic customs duty, and the price at which they will be calculating the basic custom duty is this final sale price. Now coming to the third scenario. This is also called as out and out transaction, or it is also called as third country shipment. What is this out and out transaction or a third country shipment? So let us say I've got order from US. Now what they want is manufactured in Bangladesh. What I can do is I can purchase the goods from Bangladesh, bring it to India, and then I can export it to US. But you will understand that this will consume a lot of time, plus unnecessary my shipment cost is increasing, loading, unloading charges are incurred multiple times. Plus the moment I bring it into India, I have over here various duties, charges. So it is unnecessarily lengthening the trade plus making the transaction costlier. So instead of this, what I can do is I can directly ask my Bangladesh person supplier to dispatch the goods to American address, and the bill is routed through me. So I am buying the goods from the Bangladesh supplier and I am selling the same goods to the US buyer. This is how the transaction is, the accounting is. But physically, the goods are directly traveling from Bangladesh to US without it coming to India. Such transactions are called as third country shipment or triangular trade or out and out sale. Now, in this case, goods move from one country to another without touching India. So in my example, from Bangladesh to US, and only invoicing is done through India. That is, I will first show purchase. So I'll show a purchase bill and then I'll also make a sale bill. Now again, such third party or third country shipments are to be treated neither as supply of goods nor services as per Schedule 3, and the value of such third country shipments will also not be included in the value of exempt supply for the purpose of reversal of ITC. Now, students, there is an amendment over here in relation to, if I have to talk about this part, there is one more transaction that is added over here. So like how we saw goods which are kept in warehouse are sold. So now another situation is goods which are kept in free trade warehousing zones. So they are also a special zones which are to be deemed to be a foreign land, same like SEZ. So if you all know, SEZ is treated as a foreign land, though it is physically in India, but it is deemed to be a foreign land for all taxation purposes. Similarly, this FTWZ, Free Trade Warehousing Zone, is to be treated at par with SEZ. Means it is to be treated as a foreign land, though physically in India. Now again, let us say some goods are in the FTWZ. So my goods are kept in FTWZ. I was going to export it. But before that, I found a customer in India who says, I want to buy your goods and I will export it. I said, okay, fine. Anyways, wherever I'm getting better price, I will do that. So I sell my goods to this Indian buyer. And when I sell the goods to this Indian buyer, the Indian buyer says, let the goods be in FTWZ. Don't remove them. Let it be there because from there I will export it at a later date. Now I sell these goods which are now similar to this warehouse goods, like how my goods at the time of import were kept in warehouse. Here also my goods are kept in FTWZ, and while they are in FTWZ, I sell it to somebody else and that person is now going to further export it. Again, the provision which is similar to warehouse goods is applicable. So my sale transaction to this person would be a Schedule 3 transaction. It will be treated as neither supply of goods nor supply of service, and I don't have to pay any GST. I hope this is clear, students. So these are the 4 transactions which are kept in Schedule 3, in which the latest amendment is transaction where the goods are lying in FTWZ and it is similar to the treatment of goods which are lying in custom bonded warehouse. Now coming to another important point which was amended some time back, but it is very relevant because it is something different, something new. Now what is that? If you remember, in 2023 October, an amendment was made in the GST law in which they said that if you are availing online gaming, we will be treating this online money gaming as a specified actionable claim. So now, firstly, the transaction in online money gaming is to be treated as specified actionable claim. And I'm sure you all would be knowing this. In Schedule 3, actionable claims are excluded. So again, they are to be treated as neither supply of goods nor supply of service except specified actionable claim, which means that if you are doing transaction of online money gaming, it would be treated as specified actionable claim. It would be outside Schedule 3 and hence ultimately it would be leviable to tax. Now, when this amendment came, a major question came, what will happen where the online gaming company is situated outside India? So for this, in IGST Act, a new section 14A was inserted, which dealt with the taxability of supply of this online money gaming, which is now a specified actionable claim by a person who is sitting outside India to a person who is in India. So we are dealing with what? Supplier of online gaming service who is located outside India, and such supplier itself is leviable to pay IGST. Now, for this purpose, it will have to obtain a registration. But since these people are sitting outside India, so for them, a simplified registration scheme has been brought in, whereby they can take this registration simple route. Now, if the supplier of online gaming does not have a presence in India, first, if there is a person who will be representing such overseas online gaming company, then such person who is in India and going to represent them will be the person leviable to IGST. That is, the person will be ultimately catched by the department for recovering IGST on this online money gaming. Second, if such a person who will be representing the online money gaming is not available in India, then the supplier of online gaming is required to appoint a person in India. If they fail to do this, they will not be allowed to operate online money gaming in India. Now, in case of failure to comply with above provisions by the supplier of online money gaming or a person appointed by such supplier or both, any information generated, transmitted, received, or hosted in any computer resource used for such supply will be blocked for access by the government. So in that case, public will not be able to access it. Now, students, we come to SEZ transactions. Now, within SEZ, we are first on the import side. So we will deal with taxability where goods are imported by the SEZ. Now, you have to first remember, students, that for the purpose of taxation laws, SEZ are deemed, SEZs are considered to be a foreign land in India. So even though physically SEZs are in India, but for all taxation purposes, they are deemed to be outside India. Now, once you understand this, that SEZ is a territory which is outside India, just try to equate SEZ with Sri Lanka. Sri Lanka is also a territory outside India, so you equate SEZ with that. Now, when you keep this at the back of your mind and you read the provisions of SEZ, everything will be simple. So what is the first transaction? Goods are imported by a unit or developer in SEZ for their authorized operations. Now, if SEZ, which as I said, you should deem it to be a foreign body like a Sri Lanka, if it is importing some goods, so obviously importing means it is importing from some foreign country. So a foreign country importing goods from another foreign country. So Sri Lanka importing goods from US. How is India concerned? So what is given? There will be no IGST levied. So where SEZ, which is physically in India, but for taxation laws deemed to be outside India, it is importing goods. For it, the import is exempt. That is, SEZ is not required to pay any IGST on such imports. Next, what will happen where goods are imported by EOU, which is 100% EOU? Now, in such cases, wherever the EOU, which is 100% EOU, is importing goods, it will import the goods without payment of basic custom duty, additional custom duty, IGST, and compensation cess. Then comes another concept, which is baggage. So what is baggage, students? In the language of customs law, baggage, in simple words, means your luggage. So whenever you are traveling, you will be having some luggage with you, which mainly represents your personal belongings. Such luggage is your baggage. Now, what does such baggage deals with, or what are the provisions under the GST law and the customs law relating to baggage? So whenever you have brought in your personal goods, which is part of your baggage, they are exempted from IGST and the GST compensation cess. In case there is any excess amount over and above the duty-free allowance. So when I'm saying it is exempt up to a certain limit. Thereafter, the customs law says we will be taxing them. Now, wherever the customs law limit are exhausted and your import value is exceeding their basic duty-free limit, then on such excess value, there will be only basic custom duty at the rate of 35% along with the social welfare cess or surcharge. There will be no IGST. So IGST is completely, you can say, exempted whenever it comes to baggage. But as far as the basic custom duty is concerned, there is a limit which is called as the duty-free baggage allowance. Up to that limit of your import, custom duty is exempt. Beyond that, it will be taxable. Next comes import of service. Now here, students, we get out of the customs law and we now are limited only to the GST law, particularly the IGST Act. Now, two possibilities. You are importing service for consideration or without consideration. Now, when you are importing service for a consideration in the course or furtherance of business, it will be treated as a supply, even though it is with or without consideration. In case of without consideration also, where it is imported from a related person or your distinct person who is sitting outside India, and in the course or furtherance of business, it will be a supply. In other cases, that is where it is imported without consideration, in other words, free, and from a person who is not your related person, then we will not tax it. It will not be treated as a supply. Now, what is import of service? Now, importantly, students, here customs law has no application. The definition which we are going to study here is exclusive to the GST law. It has no connection with the customs. So what is the definition? So import of service would mean supply of service where supplier is outside India, a recipient is inside India, and most important, the place of supply of this service falls in India as per the place of supply provisions under section 13 of the IGST Act. So wherever the place of supply is falling in India and the recipient is in India, but the supplier is outside, all these three conditions satisfied, it will be import of service. Students, interesting point to note over here is there is no reference of foreign exchange or foreign currency, which is the case in case of export of service definition. So in case of import of service, no need of payment in foreign currency. So it is something like this. The supplier is sitting outside India, recipient is in India, and even the place of supply falls in India. So when this is satisfied, only then it will be called as import. Now comes the question, who is the person liable to pay tax in case of importation. So first, importation of OIDER services by a non-taxable online recipient, the tax is payable by the supplier. So here RCM does not apply. Import of notified services through ECO, again tax is payable by the ECO. Next, service of transportation of goods by a vessel from a place outside India up to the custom station of clearance in India, and it is done by a foreign shipping line. If the contract is on FOB basis, IGST is payable by importer. If contract is on CIF basis, no IGST is leviable on ocean freight. Why? Because it will be deemed that in the CIF value which you have taken, the freight is included. In residual cases for import of service, the IGST is payable by the recipient of the import of service, that is under RCM. In this relation, students, a very landmark judgment of Honorable Supreme Court is in case of Union of India versus Mohit Minerals. What is the gist? In this particular case, when a ship which was carrying goods brought these goods to India and the transaction was entered into at the CIF value, so we had shifted the freight insurance component on the buyer by making the prices CIF. Now, when this is the case, it means the responsibility of bringing the goods to India is of the supplier because the price is fixed on CIF. Now, where the price is fixed on CIF, it means now the foreign exporter will be entering into some type of understanding or contract with a foreign shipping line so that the goods can reach the Indian port. Now, since the transaction is between two foreigners, the supplier is foreign shipping company, the recipient of the service is our foreign exporter. So hence the supply cannot be taxed in India, and hence in Mohit Minerals, the Honorable Court said in such cases there can be no GST under RCM on the transportation service because that is to be paid by the supplier who is outside India, that is the foreign shipping line, and it will be not applicable to India because there is no nexus with India. So whatever is the tax that is applicable is of foreign country, not of India. In short, for us, it will be not treated as an import of service, and hence there will be no IGST payable by the importer. Now comes another special category where OIDER services are imported. So if it is imported, two possibilities: by a business entity or by persons like you and me who are non-taxable online recipient, in short NTOR. Now, when a business entity is importing, where both supplier of OIDER service and recipient are in India, the place of supply is location of recipient, then tax is payable by supplier under forward charge. However, where the supplier is outside India, recipient is inside India, place of supply is India, and it is like import of service. So the tax is payable under RCM by the Indian recipient. Where both supplier of OIDER service and recipient both are in India, and the tax is applicable in case the recipient is NTOR. The tax will be payable by the supplier under forward charge. However, where the supplier of OIDER service is outside and the recipient is inside and the situation is of NTOR, the place of supply in India, and again the tax is payable by the supplier under forward charge because the recipient here is a non-taxable online recipient. Now, where these OIDER services are facilitated through some intermediary who is also located outside India, now what will be the scenario? So for this, we'll first understand what is the basis of this transaction. So intermediary is located outside. The role of intermediary is to arrange or facilitate the supply of this OIDER services to non-taxable online recipient like you and me. In such cases, the intermediary would be deemed to be supplier. It is required to obtain compulsory registration in India and pay the IGST. Second, Intermediary is not involved in payment terms, conditions, and delivery. Invoice clearly identifies the service and its supplier. It means the intermediary played role only of a commission agent. Then beyond that, it has no connection, no involvement in the supply. In such cases, the responsibility for registration is now of the supplier. Supplier means the order service supplier, and accordingly, the supplier will be paying or discharging tax under forward charge. Now, person enabling supplier of order services located outside India to comply with responsibilities entrusted under the GST law. So wherever the supplier of order services is outside India, following are the important provisions. First, the supplier or wherever case may be intermediary of such order service, they have to take registration under the simplified registration scheme. If they have appointed a representative, he shall get registered and pay IGST on behalf of supplier, that is online gaming, online order service. If ECO has neither the physical presence nor any representative in India, then the order supplier may appoint a person in India for paying the GST. If order supplier does not appoint, in that particular case, the services of that order service will be blocked by the government. What is an order service? So there are two components. First component is where the service is such that its delivery is done via some information technology using the internet or electronic network. So first limb of order services where the delivery of the service is through some online technology platform. So maybe through some app, and this is running on internet or electronic network. Second important point in order is services are impossible to ensure in the absence of information technology. That is, without the technology support, you cannot provide the service. The technology support is compulsory, is you can say the most important component. Only then such services will be called as order. Now coming to next category, services provided through ECO who is located outside. So where ECO is located outside India, if it supplies notified services, which are notified in 5.5, and it is supplying these services through its portal, that is its app, the ECO is required to pay IGST on these services. Now, where the ECO does not have a physical presence, again, if the person is available in India, representing in the overseas ECO, then such person will be liable. If there is no person available in India representing the ECO, then the ECO is either required to appoint a person or it cannot provide the services. Now, students, we come to the next part, that is a requirement of registration and the ITC eligibility in case of import of goods and services. So first, registration for import of goods. Now, importantly, if you remember, I had mentioned this at the start, the importer of goods is required to discharge IGST under the customs law, but that does not mean that the importer of service is discharging under RCM, because import of goods is not falling in the RCM section, and hence for the recipient there is no compulsion to take registration. However, if importer is already registered under GST, then it is mandatory to quote the GSTIN of such importer in the bill of entry for payment of IGST so that the importer can get the credit. Next, for importer of exempted goods, a person who is exclusively in import-export of goods which are either not leviable to GST like petrol and all, or which are wholly exempt. They are not required to obtain registration, and their PAN number, which is also authorized on the portal of DGFT, is to be treated as their number for the purpose of registration, and that is sufficient for getting the registration. In case of import of service, students, as we discussed at the very start, it would be treated as RCM under 5.3. And since it is under RCM under 5.3, as per section 24 of the CGST Act, you have to compulsorily avail registration irrespective of turnover of business. And then on every import, you will be liable to pay IGST. Just 2 minutes. Right. Students. Now, ITC in case of import. Now, as we have seen, you are paying IGST on import of goods. Whether ITC is available, yes. And it can also be used by you for paying your outward taxes. Similarly, if you are paying GST compensation cess, again ITC is available and it can be used for payment of output tax, but only output compensation cess. Next, you are paying basic custom duty, the customs basic social welfare surcharge. This is not available as credit, so this always becomes your cost. In case of importation of service, again the IGST paid on import of service is available as ITC. Here you pay it under RCM, so it has to be first paid through the cash ledger. Then you can take credit, and that credit can be used for paying your output tax liability. Interestingly, on this, since customs law do not apply, there will be no basic customs duty. So only the IGST component is there in case of import of service. Next, interstate supply. Now we have section 7.5. Just a minute, students. Sorry. Huh, huh. So students, interstate supply. Now this is the definition as per the IGST Act. So the IGST Act defines both interstate and intrastate. Now we have been seeing above that imports are covered under interstate supply. So let us see how section 5, 7 bracket 5 of the IGST Act defines it. So it defines interstate supply. It says that supply of goods or service or both. First, where it is done to SEZ unit or developer, or it is done by SEZ unit or developer. In both cases, it will be treated as interstate supply. Or where supplier is located in India and the place of supply is outside, it is again interstate supply. Or where it is in taxable territory, but it is not covered in intrastate supply, and it is also not covered elsewhere. So what is not covered anywhere will be falling in interstate supply. Now coming to another point, establishment of distinct person. Now what is this? Now students, you would be knowing that where you are having your multiple place of business within India and you register your places of business which are falling under the same PAN, they are said to be distinct persons, correct? So what is a distinct person? So distinct person is that establishment of yours which has a separate GST number but falling under the same PAN. Now interestingly, we have a concept called as establishment of the distinct person. What is this concept? So where you have an establishment in India and you also have another establishment outside India. So this will be the first case where it will be called as establishment of distinct person. Second, you have an establishment in one state and establishment in another state. Again, it is establishment of a distinct person. You have establishment in one state and you have establishment which is registered in the same state. So now both these are in the same state, but one is a registered establishment and one is only an establishment that is not registered. So such scenarios where you have these different types of establishments, it will be called as establishment of a distinct person. Now what is to be noted is a person carrying on a business through a branch, agency, or any representational office in any territory shall be treated as having an establishment in that territory. So what it simply means, if I have to put it very simply, when you take a registration, it becomes a distinct person. But where you have an establishment, but registration is not applicable, so you have not taken a registration. But that establishment is also falling under the same PAN, but not having a registration. It will be called as establishment of distinct person. And if it is registered, it will be called as distinct person. So this is what is the differentiation. Now, till now, we were dealing more on the inward side. Now we come to the outward side, where you have this concept of zero rated supply. What is a zero rated supply? First is export of goods or services or both. It will be a zero rated supply. Second, supply of goods or service or both for authorized operation to SEZ or SEZ developer will also be treated as zero rated supply. Right? Now, what is the relevance of this zero rated supply? So if, let us say I'm talking about export or I'm talking about sale to SEZ, what is the relevance? Why they have been treated as zero rated supply? Because as I was telling you at the start, see, whenever you are exporting anything outside India, we want our goods and service to be competitive in foreign market. Now, how they will be competitive in foreign market? They will be competitive in foreign market because or by the way of sorry only where there is no domestic tax embedded in it. Now, if your good service which you are exporting outside India is bearing the burden of any domestic tax of India, which is part of the cost of these goods or services, so you can understand to that extent our goods and services will be costly in the international market. So to make our goods and services cost effective, to make our exports competitive in market, the option that has been carved out in the GST law is treating them as zero rated supply. Now, what is the impact of this? If you treat them as zero rated supply, what will happen? Anyways, on the outward side, there is no GST. But what I also want is that on the inward side, that is for making this outward supply, whatever on inward supply you have procured and paid GST on that, you should get the refund of that inward side GST. Now, how that is possible? First is Section 16 of the IGST gives you two options. It says that supply of goods or service or both, you can supply it without making payment of IGST on the outward amount by giving a bond or letter of undertaking. Now, if you supply your goods and service under bond or LUT, on that goods or service on the outward value, you don't have to levy IGST. But at the same time, whatever is your unutilized ITC, which you have taken on the inward items, that you can get back by applying for a refund. Second possibility is notified class of persons can make zero rated supplies or notified class of goods and service may be exported on payment of IGST. Now, interestingly, here, even though not applicable, but you are first levying IGST on your outward, that is on the export value. But don't worry, it will not add to your cost because this IGST, what you have levied on your export value and paid, we will refund back this IGST. So, whatever IGST you have paid, that entire IGST is refunded back to you. So, in any case, your goods or service which are exported or which are supplied to SEZ becomes tax free, and whatever is the embedded domestic tax that is given back to you as refund. Now here you have to keep in mind, in case there is non-realization of your export sale proceeds, the supplier of the zero rated supply will be required to return back the refund. So we gave you refund in the above scenario, but if your export sales did not get realized, means the foreign buyer did not make payment to you, that too in foreign currency in the notified time, then whatever refund I had given to you, you will have to return back the refund to me. And this has to be done with interest after the time limit prescribed under FERA. So if you are not getting the foreign currency remittance within the time limit of FEMA, then once the time limit of FEMA is over, there will be interest exposure. Now, many times I have found student mixing up between exempt supplies and zero rated supplies, because you'll say, sir, zero rate means there is no tax and hence zero rate is also exempt. Let me first tell you, zero rate does not mean the tax is zero. Zero rate, as we saw above, covers two supplies. One is export, one is SEZ. Now, in that case, your goods and service are bearing some tax, which may be 5 earlier, 12, 18, 28 earlier, now 48, or even 0 or nil. So your outward is bearing some tax. But the moment you export it, the moment you sell it to SEZ, we call that outward as a zero rated supply. Sorry. So basically, students, a zero rated supply is a supply where your goods are not actually exempt. They are leviable to GST, but since you are exporting it, since you are supplying it to SEZ, as a tax relief measure, we are putting it in the category of zero rated. Whereas, as against this, what is the exempt supply? Exempt supply is a supply where either the rate in the rate schedule is nil, or it has been made fully exempt from GST, or it is non-leviable to GST. All these supplies are treated as zero rated, exempt supplies. So exempt supply means supply of goods, services which attracts nil rate, or which is wholly exempt from tax, and also includes supplies which are outside GST. As against the zero rated will cover export, of goods or services or supply of goods or services to SEZ for authorized operations. Importantly, there is no tax on the outward exempt supplies. However, the input supplies which you are using for making these outward supply may be attracting tax. Again, in case of zero rated, there is no tax on outward supply and your inputs services to be tax free by way of refund. So whatever is on your input side, even though GST is applicable on them, but you can get it back as refund. So to that extent, your inward supply becomes tax free. Next, credit of input tax need to be recovered if taken and there is no ITC on exam goods. Whereas credit of input tax is allowed to be taken where you are making outward zero rated supply, even if such supply is exempt, and this ITC which you have availed can also be refunded back. Further, the value of exempt supply will also be considered while doing the proportionate reversal under section 17(2), and this value of exempt supply shall include transaction in securities, sale of land, and sale of completed buildings. So these values would be considered as exempt supply for the purpose of proportionate reversal. However, since zero rated supply is not exempt supply, in the computation of proportionate or 17(2) reversal, it is part of taxable supplies, not exempt supplies. Further, a person who is engaged exclusively in business of supplying goods or service that are not liable to GST or which are wholly exempt is exempted from registration. But a person who is making exclusively zero rated supply has to get registration as they need to apply for refund. So for that purpose, they need to take registration. A registered person supplying exempted goods or services will issue bill of supply and not tax invoice, whereas a person who is making zero rated supply will include normal tax invoice and not bill of supply. So these are some comparative points, students, between exempted supplies and zero rated supplies. Now, students, we talk about export of goods and services. First, similar to import of goods and import of services, export is also to be treated as interstate supply. And most important, besides being interstate supply, it is also treated as zero rated. What it means we have seen above. Important, even though it is treated as zero rated, still you are eligible for ITC. And even if there is exemption on your outward supply, still, since it is zero rated, you become eligible for ITC. Most important, whenever you will be levying any tax on your exports, it will always be IGST because it is always treated as interstate. Now, what is the definition? So for definition of export, as I had mentioned earlier, we go to the customs law and the same definition, students, is also incorporated in the GST law. GST defines export as taking the goods from India to a place outside India. So only when physically the goods are going from India to outside, we call it as export. Keep this in mind. Now then there is a concept which is deemed export. What is this? Goods but not services which are supplied, are manufactured in India. These supplies are within India, that is, they do not go outside India, and these supplies cover some notified supplies. Then only they are deemed as exports. So in order to be deemed as export, you have to keep in mind first, deemed exports only cover transaction of goods, not of services. Two, here goods are within India, that is, it is a domestic transaction. Three, only notified transactions will be treated as deemed exports. Importantly, since the goods are within India, the transaction is internal. The payment is received in INR or in Forex. Both are possible because the transaction is within India. Now, what are those notified cases which are to be deemed as exports? So first, supply of goods by a person against the advance authorization. So where a person is having advance authorization, if against that advance authorization goods are supplied. Similarly, if any capital goods are supplied by a registered person against the EPCG license or EPCG authorization. Next, supply is made by 100% EOU, 200% EOU, and where the supply of goods is by a specified bank or PSU against advance authorization and they are gold. So these are the cases, students, which are to be deemed as export. Now, how you deal with deemed exports? So such supplies are taxable. They are not zero rated, they are not exempt. So you levy tax in the normal manner. Now, importantly, keep one more thing in mind. These are not exports, these are deemed exports. So, what is very important, students, is they are not to be treated as interstate. We will not deem them to be exports, they are deemed exports. They are not to be treated as interstate. So, such supplies may be intrastate, may be interstate, depending upon the provisions. Such supplies can be made on payment of tax and it cannot be supplied under bond. So, importantly, not like this export. In case of export, you are having the option of making with payment or without payment under bond. Here it is not export, here it is deemed export. You have to compulsorily do it under payment mode. There is no option of without payment. Now comes the most important part. Now you'll say, sir, if everything is like domestic supply, then why you are calling it as deemed export? What is the purpose or effect of this? So the effect is here. The effect is that whatever is the tax which is paid on this supply, as we discussed here, it is compulsory to pay tax. That tax can be taken as a refund. Interestingly, the refund can be applied either by the supplier or by the recipient. Between them, mutually, they will discuss and decide who will apply for the refund. Now comes again a special transaction which is called as merchant export transaction. Now, what are merchant export transactions, students? Let us understand. So, I am a manufacturer in India. I am manufacturing some goods which are to be exported. But for some reason, I myself cannot directly export these goods. Now, when I myself cannot export these goods, but ultimately these goods are to be exported, then comes this point of merchant export. I will sell these goods to a person who is going to ultimately export them. So I am the manufacturer of these goods, but I myself am not exporting or cannot export. So I will be selling it to a person who will be actually exporting. In this particular case, I will be the manufacturer exporter and the person to whom I have sold who will finally make the ultimate export is the merchant exporter. So in this particular case, there is a concessional rate, which is an option given that when I'm selling to the exporter, who is also the merchant exporter, I will not charge the regular rate, whatever it is on these goods. Rather, I will charge a discounted rate of 0.05, 0.05, or if it is IGST, then 0.1%. And I will have to follow certain conditions and I have to do certain compliances. If all those conditions and compliances I'm ready to follow, then I will charge the concessional rate to the merchant exporter. And the very first condition is that the merchant exporter has to compulsorily export these goods under bond. So I will supply to the merchant exporter with this concessional rate. The merchant exporter has to compulsorily export under bond, that is without payment of IGST option. Now, since I have supplied under this concessional rate, I will be eligible to claim refund. Which refund? Of inverted duty structure. Because as a manufacturer, I have procured my raw material, my other items at regular rate. And my outward sale, which is to a merchant exporter, is at a discounted rate. In such cases, whatever tax I have paid on my input side is higher than the tax which I'm paying on my output side. So difference I can get back as a refund, which is also called as inverted duty structure refund or the IDS refund. Similarly, the merchant exporter, who is the ultimate exporter, will get the credit of this 0.1% tax charge by me, and that credit again it can avail for a refund. Now, what are the special conditions applicable if I have to follow this merchant exporter route? So in such cases, we both should be registered. Myself, that is a merchant exporter, plus the registered, I am the manufacturer exporter, and the person to whom I am selling who will make the ultimate export, that is the merchant exporter. Both are required to be registered. Now, I will be issuing a regular tax invoice, and when I'm selling these goods to the merchant exporter should have actually exported these goods within 90 days from the date of my invoice. Now, the recipient will indicate my GSTI and invoice number on the shipping bill. So recipient means the merchant exporter who has procured these goods from me will be mentioning my details on the shipping bill in the manufacturer column, so that the linkage can be made that whatever goods I had sent to him, the same goods the person has exported. Further, the recipient, that is a merchant exporter, should be registered with one of the export promotion council. Further, the recipient shall place order on the supplier for procuring of the goods at the concessional rate and shall provide a copy of it to the jurisdictional tax officer. Now, importantly, when I am supplying these goods to the recipient, first possibility is the recipient will move the said goods from place directly to the port, ICD, airport, etc. That is the place from where it will be exported. Or these goods will be directly sent to the registered warehouse. What is registered warehouse? It means the registered principal place or registered additional place of business can be treated as registered warehouse, from where the goods shall move to the port. In short, what this particular condition means, that whatever goods I have manufactured, they would be sent directly to the port, airport, or the warehouse. It means the merchant exporter will not be doing any further activity or processing on the goods, and hence the goods have to move directly to the port, airport, or the registered warehouse. Now, students, we come on the export of service. Now, in export of goods, there weren't much conditions, but when you come to export of service, there are multiple conditions. First and second is common. Supplier is inside India, recipient outside, first condition. POS is outside. What is important is the further conditions. What is the first additional condition? The transaction is between separate entities, that is not merely my own branch outside. So when I'm exporting, the export has to be to a different person, not merely my establishment, my branch outside. If I'm sending or supplying the service to my own branch outside, it will not be considered as export. And next is, I should receive the money in convertible foreign exchange. Now, what are the common provisions for export of goods and services? So first, supply to SEZ unit or developer. Whenever there is a supply to a SEZ unit or developer, it will be treated as zero rated. Now, once it is zero rated, I can claim refund of the ITC, which is unutilized if I'm doing this supply under bond. Or second option is, I can sell these goods services to SEZ by levying GST, which will be IGST, and then taking the refund of that. What are the conditions? Such supplies should be part of authorized operations of the SEZ. So the SEZ to whom I am supplying these goods services, for them, this should be covered in their authorized operations. Next, there should be an endorsement made from the officer of the SEZ on my invoice that yes, these goods are inverted in the SEZ for that particular SEZ's authorize operation. So that type of endorsement, that type of, you can say, certification has to be done on the invoice by the SEZ officer. Now, when I am doing transaction with EOU, then whenever I am supplying to EOU, we already studied it is not a zero rated supply. It will be treated as any other supply. However, it is to be treated as a deemed export. And since it will be treated as a deemed export, first we will pay the tax. And after the tax is paid, then the refund of the same tax can be applied either by the supplier or by the recipient. Wherever there is export done by EOU, so that is EOU is now procuring from me and doing export, that will be eligible for zero rating. Next, students, is procedure for direct exports. So where I'm doing an export, so rule 96A, what it says, exporter has to execute bond or LUT before export and pay tax with 18% interest within 15 days after the end of 3 months, and if any other further period is allowed, from the date of invoice issued if goods are not exported outside India. So if I fail to actually export the goods within 3 months from the date on which I have prepared the invoice, I will be liable to pay the tax and interest. Similarly, for export of services, I will be required to pay tax and 18% interest within 15 days after the end of 1 year from the date of invoice if I have not received the money in convertible foreign exchange. So as we saw, this is part of the definition of export of service, that the money should have been received in convertible foreign exchange. So where the money is not received up to 1 year, I'll have to pay the tax with interest. Now, if a registered person is making zero rated supply, and what is the option without payment of tax, that is under bond or LUT, then in case of non-realization of sale proceeds, he would be liable to deposit the refund so received under section 16(3) interest within 30 days after the expiry of time limit provided under FEMA. So if I have taken the refund and after taking the refund, I have not received the amount in foreign currency within the time limit of FEMA, in that particular case, there will be a challenge. I will be required to return back the refund. Failure to export and paying tax with interest leads to withdrawal of facility of export without payment. So the LUT which is given to me will be withdrawn, and recovery of the said amount under section 79 of the CGST Act will be initiated. This facility will be restored once I make the payment. Now, registered persons are eligible to furnish LUT in place of a bond, except those who have been prosecuted for cases involving an amount of more than 250 lakhs. So, wherever a registered person is required to furnish LUT, that can be done without giving up. Next. The details of the export invoices should be uploaded in the respective table of GSTR 1. Now we come to another special case, that is export to Nepal and Bhutan. What it says, export of goods. Such export falls within the definition of export as per the IGST Act. RBI allow recipient of payment even in INR. India has a rupee trade with Nepal and Bhutan. That is why INR is allowed. It is strictly as zero rated and eligible for zero rating benefits. Non-realization of export proceeds within the time limit of FEMA may result in the recovery of the refund amount. Whereas when you are exporting service to these countries, RBI allows receiving the payment in INR in case of export to Nepal, Bhutan, in case of supply of service, and such supply in Nepal or Bhutan against payment in INR is considered as export subject to fulfillment of other conditions. So even though, if you remember, students, within the definition of export of service, there was a specific condition that money should be received in foreign currency. But for this particular case, that is where you are exporting service to Nepal, Bhutan, even receiving the money in Indian currency will be deemed to have fulfilled this condition of receiving payment in foreign currency, right? Now let us go to few of the test knowledge questions. So A Limited enters into an agreement for sale of goods with B Limited, a company based in UAE. B Limited requires goods to be delivered by A Limited to C Limited, which is a company in Karnataka. Whether the transaction will qualify as export, analyze the scenario, offer your comments. Now see, students, you have to be very particular. For export of goods, the goods should physically move outside India. This is what we have seen in the definition. Now here what has happened? A, which has entered into an agreement with B, and B is a company based in UAE. So B requires that A delivers the goods to C. And where is C? C is a company based out in Karnataka. As per the details, it is not mentioned where A is based out. We are also assuming A is based out in India. So B, which is a Dubai-based company, has contracted with A, asked A to deliver goods to C, who is also in India, that is in Karnataka. Now, in such cases, whether this can be treated as export. So for this, as we have seen, the definition of export under section 2.5 explicitly means or requires that the goods should be taken outside India to a different place which is outside India. Now, in the given case, since the goods are not going outside, that is, the goods are being transferred to C, which is in India, Karnataka, the transaction between A and B, because A has actually sold goods to B, the B has put a condition that A delivers the goods to C. So effectively, transaction is between A and B, but on the instruction of B, A has delivered the goods to C. So it is like a bill to ship to transaction where you are billing to a foreign country but shipping to an Indian company only. In such cases, such transaction, even though with a foreign buyer, cannot be treated as export under GST, rather even under customs. Why? Because the goods have physically not moved outside India. So this is what is the important point to be noted. Another case scenario, A Limited is making zero rated supply, which are also specifically exempt from GST. Now see students, this is again a very important point. So let us say your supplies are covered under the exemption notification. Now, we all know when supplies are covered under the exemption notification, which we have already studied in the exemption chapter, those supplies are treated as or are called as exempt supplies. Now, what is the effect of the exempt supplies? If your outward supplies are exempt, then the challenge, students, is that you are not allowed to avail the input tax credit. Now, this is the general point. However, here an interesting point is your supply is exempt, but what you have done, you have exported that supply. Now, the moment you export that supply, it is treated as zero rated. So now the scenario is what you have exported is an export item, is an exempt item. So for example, we have exported agricultural produce. We all know agricultural produce is exempt. Now, if you have exported agricultural produce, which is an exempt item, but because of export it has become zero rated, the question is what will happen to the input tax? So here in this case, the company has input tax credit of 2 lakhs, which it has paid on the procurements of input and input services, which is it is going to use exclusively in this export supply. So the question is whether the company can avail the ITC of 2 lakhs paid on the input services, which it is going to use exclusively for the export, that is the zero rated supply. Now, if you recall our discussion on zero rated compared with exempt supply, you will recall that if it is an exempt supply, you don't get ITC. If it is a zero rated supply, you get ITC. But the question is, what if the exempt item itself is exported? That is, the exempt supply becomes a zero rated supply. In that case, students, section 16 of the IGST Act specifically says that where you are exporting or you are supplying to SEZ an exempt item, it means this transaction becomes zero rated even though it was otherwise exempt. Still, what will happen? It will be eligible for ITC. So the answer to this will be, as per 16.2 of IGST Act, ITC can be availed for making zero rated supply, notwithstanding that originally these supplies were exempt. However, it is subject to 17.5. It means it should not be blocked. That is obvious. So blocked supplies anyways will never be allowed. Now, hence, in this case, since A has made zero rated supply, even though of exempt item, still it is entitled to get the ITC, whatever tax it has paid on the inward side on inputs and input services. Under situation, whether service of short-term accommodation, conference, banquet, etc., which is given to SEZ unit developer by a supplier located in same state as that of the SEZ should be treated as interstate supply under 17.5 or an intrastate supply. Now here students, interesting point is, we all know wherever you are making supply in the same state, then as per section 8 of the IGST Act, that supply is treated as an intrastate supply, correct? However, the conflicting point is section 17.5 says that any supply made to SEZ will be treated as interstate supply. Now here comes the conflict. So there is a conflict between both the sections because you are making supply within the same state. Section 8 says this should be interstate supply. Since this supply is made to a SEZ unit, section 7 says this should be an intrastate supply. Now in such cases, what should be the final take or what should be the final answer? So the final take or the final answer is that specific provision is superseding the general provision, and because of this, the answer would be that even though what you have done is made a supply within the same state, but since that supply is made to SEZ unit or developer, because of this specific provision, it is treated as interstate supply. Whereas, as per 12.3c, the supply of service by way of accommodation in immobile property, the location will be the immobile property itself. Thus, in such case, if the location of the supplier and the place of supplier in the same state, it would be treated as intrastate supply. However, what is the established principle of interpretation? So, see, there is a conflict between these two provisions. Now, what is the principle of interpretation? That in case of conflict between two provisions, the specific will prevail over general. Now, in this case, 7.5b, which is dealing with interstate supply to SEZ, is a specific provision which says that such supplies are interstate supplies, whereas 8.2 is dealing with generic provision. And further, the proviso to 8.2 specifically says that intrastate supply will not include supply to SEZ. Therefore, it is finally clarified that whenever you are giving accommodation service, conference service, etc. to SEZ, who is within your same state, still it is an interstate supply because of the specific provision of SEZ. Next, Mr. Amarkant, a chartered accountant, being a practitioner in GST registered firm, orders a gaming software for his son from a company located in USA. He makes the payment for the same from his personal bank. Examine whether the transaction is leviable to GST and in whose hands. Now here students, what is the catch? So you are going for a gaming software. So this is order service. And this is done from a person in USA. So the supplier is outside India. However, the challenge or the point is that the recipient is a registered person. Interestingly, so it is a chartered accountant who is registered under GST, but he is doing it for a personal use because he has purchased this software not for his office, but it is a gaming software purchased for his son. In such cases, firstly, whether it is taxable, and secondly, how it will be taxable, that is to whom. So first we understand the nature. The nature of supply is order because you are going for a gaming software which will be compulsorily requiring the use of technology for its supply. Then comes the next point. The transaction is for personal consumption of the chartered accountant, and the payment is also made from his personal bank account and not from his firm's bank account, which is registered under GST. Therefore, for the purpose of this transaction, the person will be treated as an unregistered person receiving OIDR services in the taxable territory. So the chartered accountant will fall in NTOR, that is non-taxable online recipient. Please keep in mind, since he has paid from his personal bank account, since he is procuring the service for his home, that is personal use and not for his office, for the purpose of this transaction, the registered person, the registered individual will also be deemed to be unregistered. That is NTOR specifically. And then services received from a provider of services who is outside India by an individual for purposes other than commerce, industry, business is exempt from IGST. Interestingly, however, such exemption is not available in case of OIDR service. So this could have become exempt because of this specific notification, but there is a carve out, that is OIDR is not covered. Therefore, since our service is OIDR and since the supplier is located outside and the recipient is a non-taxable online recipient, it is leviable to GST. So first thing we have understood or concluded that this transaction is covered under GST. Now comes the next part. The next part is who is liable to pay tax. Now here, the tax on this service, which is supplied by a person from outside India to a person who is NTOR in India, is covered under forward charge. It will not be covered under reverse charge. Therefore, the tax on OIDR services provided by the company in USA to Mr. Amar Khan, who is a NTOR, will be payable by the US based company. And we have already seen there is a special section 14A under which this foreign company will have to take registration, will have to appoint a person in India, and through that person, the government will be recovering the tax. But the most important point is the company will be required to pay the tax under forward charge. Let us go to one more case, students. So AXT entered into a high C sale transaction with BYU for certain goods. Now AXT is of the view that GST on such sale transaction is payable at the time of such sale, and the basic custom duty is payable at the time of filing of bill of entry. Now we all know that in case of high C sales, when you are making sale to another person while the goods are in high seas, that is in transit, in such cases, students, your transaction falls under Schedule 3 of the CGST Act. Since it falls under Schedule 3 of the CGST Act, hence there is no GST applicable because it will be treated as neither supply of goods nor supply of service, and it will not be leviable to SGST or CGST or IGST. Hence, in this particular case, the first point, what the company is saying, that at the time of sale transaction itself, it is required to pay GST is incorrect because the GST will not be levied at the time when AXT Limited sells to BYU, that is at the time of high C sales. Then when will the GST be applicable? The GST will be applicable only at the stage where the recipient will be taking the goods from the customs. So at that point of time, the GST will become applicable. So what is the answer? Supply of goods by the consignee to other person by endorsement of document of title after the goods have been dispatched from the port of origin outside India, but before clearance, is neither supply of goods nor supply of service. So this is what is Schedule 3 saying. Thus, the GST is not leviable on high C sale. This is the first part of the answer. Therefore, A Limited's view that GST is payable on high C sale transaction is not correct. But as per section 14 of the customs, the value for the purpose of charging customs duty on the imported goods is the value at the time of importation, that is the time of filing of bill of entry. Further, IGST is also levied at the same time. Therefore, in case of high C sales, The assessable value of imported goods for levying customs duty and IGST is determined on the basis of price paid by the last IC sale buyer who files the bill of entry. Therefore, AX Limited's view that basic custom duty is payable at the time of filing bill of entry is correct. So that part of his view is correct, but the part that it will be payable at the time of import is incorrect. Fine, students. So with this, we have completed this chapter. Now we'll take a break and we'll go to our other chapter on refund after the break. So we go to the next topic for today, that is refund. Now, student, this is more of a procedural topic. So let us try to understand. Now, refund is covered under Section 54 of the CGST Act. The first thing which we need to understand is what are the different scenarios where the law entitles you to claim refund. So the different scenarios are: first, where you are exporting outside India or you are supplying to SEZ. Now, in both cases, which is also called as a zero rated supply, where this is done on payment of IGST. So first option, as we saw in the previous chapter, also section 16 of IGST Act gives you is that in case of zero rated supply, you have to first option make payment of IGST and claim the refund of that. So that is the first situation where you are exporting your goods services or you are supplying your goods services to SEZ for their authorized operations, and you are doing this by charging IGST, that is with payment option. The amount of IGST which is paid by you can be refunded. Second is in this same scenario, that is where you are exporting or supplying to SEZ unit or developer, but you are not charging the GST. Now this is what is done in case of LUT or bond. So wherever you are supplying to them and you are not charging GST, or your case is falling under the inverted duty structure. And in both these cases, what is happening? You have an unaccumulated, unutilized ITC. So since your outward is without payment, the IT is accumulated, or because you are in inverted duty structure, again your ITC has accumulated and you were not able to utilize it. Such accumulated unutilized ITC can be taken as refund. So the different scenarios beyond these two. So first two are export and SEZ supplies. One is with payment, second is without payment. Next is refund of tax paid on supply of goods which are treated as deemed export. Again, we saw this in the previous chapter, what are deemed export. Over there, either the supplier or the recipient, one of them can claim the refund. Next scenario is refund of balance in your cash ledger. So after settling all your liabilities and dues, if still amount is lying in cash ledger is your own money, you can anytime take it back as refund. Second, refund on account of tax paid on supply which is not provided. So let us say you have received money in advance. This is mainly for services, and you paid the tax on advance because of time of supply provision. But later on, for some reason, the supply was not made. Now, in this particular case, you can get the amount of tax paid back as a refund, provided you have refunded back the amount to the recipient. Next, where refund of tax wrongly collected and paid to government. So you have treated the supply as intrastate and paid CNS, but it should have been interstate or vice versa. Next, another scenario of refund is refund of GST paid by a tourist who is leaving India on supply of goods taken out of India by him. So if let us say there is a foreign tourist who is buying something in India and later on is taking those goods outside India whenever the tourist leaves India. So at the airport, the tourist should produce the invoices and take the refund from there. Next, tax becomes refundable as a consequence of judgment, decree, order, direction of the appellate authority or the courts. So if let us say your matter is in some appeal or in tribunal or court, and from there you get a favorable order. Next, whenever originally the assessment was done provisionally, later on this provisional assessment is made final, and at the time of finalization of this provisional assessment, it was found that on provisional assessment the tax paid was higher, and on finalization it has been reduced. So the excess tax paid can be taken back as refund. Next, refund of taxes on purchase by United Nations or embassies. For them, there is a specific provision for refund. Next, We studied this in registration topic that a casual taxable person or a non-resident taxable person has to pay tax in advance at the time of registration long before they actually start their supply. Now, after their supply is over, and when they prepare the returns and they found that the amount paid in advance was excess, the excess paid can be taken back as a refund. Next, refund of additional IGST paid on account of upward revision in price of goods subsequent to export. So what you have paid tax on export, that you took refund in the first point. But let us say after export, after few days or a month, there is some upward revision in price. Now here you're only issuing an invoice with the upward revision in price or a debit note as per the provisions of GST. Now whatever is the GST paid on this upward revision amount, that again you can claim as refund. And then last is refund of excess payment of tax. So wherever you can prove that for any reason the tax paid is in excess, you can go for a refund. Now comes the second point. So once you fit in any of the above scenarios and you are entitled to refund, the second comes the process of taking this refund. So in this, there are two possibilities. One is you have paid the IGST at the time of export. For that, you need not make any application. Once you pay the IGST on export, you file your GSTR1 3B with proper details. Upon filing of 3B, the GST portal matches your export with the IceGate portal, which is the customs portal. And when the entries at both portals matches, you get the refund automatically. So over there, no application is required. This application is required in all other cases where either of unutilized ITC or of balance in cash ledger or of excess tax paid or of deemed export. In any of these scenarios, you have to go by the application rule. Now this is covered in Rule 89. What does it say? Firstly, you have to make an application in form RFD 01. Now, importantly, a person who is claiming refund of the additional IGST paid because of upward revision in price, on which refund of IGST paid at the time of export of goods has already been sanctioned. So for the additional amount, you will have to file RFD 01. Similarly, where you want to take refund of balance in cash ledger, again you have to file RFD 01. Similarly, if you want to take refund of TDS TCS, so your supplier or the e-commerce operator or the government to whom you have made supply has deducted your TDS TCS and that amount has come to your cash ledger and it is lying as balance, you can claim that as a refund. Further, a registered person who has been issued a certificate of registration shall undergo Aadhaar authentication for filing a refund application. Next, however, in case of refund of IGST paid on goods exported outside India, there is no need to file, as I already mentioned. So wherever you are doing tax paid exports, the shipping bill filed by the exporter itself is treated as a refund application. You need not make any separate application. Now, now comes the refund application in case of supplies which are regarded as deemed export. Now, in the previous chapter, we saw the list of supplies which are regarded as deemed export. First point, students, you should keep in mind is that deemed export is not export. So compulsorily it is to be treated as a domestic supply and it will be categorized as C plus S or I depending upon the nature of supply. Now, once the supplier in case of deemed export has filed the GSTR1 showing the deemed export in the proper table and paid the tax in 3B, then comes the next step, which is the refund. Now, the refund in respect of deemed export is the refund of tax which you have paid on this supply. The supplier can seek the refund where recipient does not avail ITC. So obviously, what tax supplier has charged, the recipient should not take ITC. Only then the supplier can apply for refund. Otherwise, there will be double benefit. Now, for this, an undertaking has to be taken from your recipient by the supplier. Second possibility, the refund can be claimed by the recipient. The GST portal requires them to first debit the amount equivalent to refund from their electronic credit ledger. So now supplier charge GST to you, you are the recipient. Obviously, the refund is coming and sitting in your GSTR 2B and through that it is coming in your 3B. So now whenever you are making an application, obviously you'll have to debit that refund amount so that you'll reduce the ITC balance. You have to furnish an undertaking stating that the refund has been claimed only for those invoices the details of which you are furnishing in this application, and for the tax period for which refund is being claimed. The amount does not exceed the amount of ITC. So all this you have to give as undertaking. Next, entire amount paid by the recipient is available as ITC even if blocked under 17.5. So this is a very specific point. Only in case of deemed exports, this rule is applicable, that where in case of a deemed export, the supplier has charged GST, the buyer has availed the ITC, even though that ITC is falling in the block list of 17.5, still, in case of deemed export cases, it will be still entitled for refund. Next, the question is that whatever is this ITC, which the recipient will be claiming as refund, whether it is to be covered in the net ITC, which is the working for computation of remaining refund. So it is clarified that such ITC, which is availed by the recipient of deemed export for claiming refund of tax paid on supplies regarded as deemed export, is not to be included in net ITC for computation of refund of unutilized ITC. So if the same recipient, that is a recipient of deemed export, is also entitled to any other refund because that person, let us say, is making some exports. In such cases, while doing the calculation of that other refund, the ITC will not include this ITC because this is allowed to as a refund separately under the deemed export category. Next, whenever you are making supplies to SEZ unit or SEZ developer, then refund application shall be filed by the supplier after such goods have been admitted in the SEZ for the authorized operation, and this has to be endorsed by the officer of the SEZ. Similarly, for supply of services, you should have evidence regarding the receipt of services for the authorized operation, again, which has to be endorsed by the officer of the SEZ. Now, who is this officer? So for the purpose of this sub rule, specified officer means either joint or deputy or assistant commissioner of customs who is posted in SEZ, or an authorized officer who may be inspector, preventive inspector, superintendent posted in the SEZ and authorized by specified officer to discharge the above function. Now, whenever supplies are made by casual taxable person or NRTP, as we have seen in the registration chapter, they have to pay tax in advance at the time of applying for registration. Now, after their supply is over, if the tax is found in excess, it can be claimed as refund. Now comes the most important question. What is the time limit? The law says, section 54 says, this refund application has to be filed within 2 years. 2 years from which date? From the relevant date. Now comes the question, what is the relevant date? But before that, it has been clarified that the time limit of 2 years is not applicable in case of refund of excess balance in cash ledger, because cash ledger is your own money, you can refund it anytime. Further, in case where proper officer has issued deficiency memo to the applicant requiring him to file a fresh refund application, the time period from the date of refund claim till the date of communication of deficiency in the prescribed form by the officer shall be excluded from the period of 2 years. So let us say I've already applied for refund once. At that time, the officer issued a deficiency memo, but between this time, application to deficiency memo, 50 days have passed. So 50 days will be excluded while counting 2 years. Now, what is the relevant date? That is the date from which 2 years will be counted. Now, different scenarios, different relevant dates are provided. First, where it is the case of export of goods and the refund of tax is available in respect of the goods themselves or as the case may be of the inward inputs. Then what is the relevant date from which 2 years will be counted? If the goods are exported by sea or air, the date on which the ship or aircraft leaves India, from that date, 2 years. Where the goods are exported by land, the date on which such goods cross our borders. Where they are exported by post, the date of dispatch of goods by the post office to the foreign place. Then comes the second category. In case of deemed exports, what will be the relevant date for counting 2 years? It is the date on which the return relating to such deemed export is furnished, irrespective of fact whether the refund is claimed by supplier or by recipient. As the tax on the supply of goods is regarded as deemed export, it would be paid by the supplier in his return. Therefore, the relevant date for the purpose of filing refund claim for the purpose of such deemed export supplies would be the date of filing refund return by the supplier. So whenever the supplier files his 3B return, in which these deemed exports are shown as the outward supplier, from that date of the 3B return of the supplier, you have to count 2 years. Then comes the third case, that is where in case of zero rated supplies, either of goods or services to SEZ or developer, where refund of tax is available in respect of such supplies themselves, it will be the date of filing of such return. So the date of your 3B return will be the relevant date for counting 2 years. Next, in case now where you are exporting services outside India, then the supply of service has been completed prior to receipt of payment. So that is, you have first supplied the service and in future you are receiving the payment. The date of receipt of payment in convertible foreign exchange or rupees wherever permitted, that is the date for starting 2 years calculation. Where opposite has happened, you have received payment in advance. So you have received the payment first and then the services are provided. It will be the date of issue of invoice. Next scenario, where tax becomes refundable as a consequence of judgment, decree, order, or direction of some appellate tribunal or court. Obviously, the relevant date will start from the date of communication of such judgment, because the judgment may come after 5 years, 6 years, 10 years. So from the date of judgment, you will count 2 years. Wherever you are applying for refund of the unutilized ITC because of inverted duty structure, again, the relevant date is date of furnishing your GSTR 3B return in which such refund claim arises. Next, where tax is paid provisionally and later on in final assessment, it is found that there is refund. So date of adjustment of tax after final assessment, that date is the relevant date. In case of a person other than supplier, so this is where the recipient is claiming refund, it will be date of receipt of goods or service by the recipient will be the relevant date. And in any other case, date of payment of tax. So student, this table is very important for your exams. You should remember what will be the relevant date for counting the 2 years time limit. Then comes the next point, clarification on bunching of refund claims. Now the question that arises is, I have refund arising in every month. So should I file the refund application month by month? The law says not necessary. You can club and file for quarter or for 5 months or for 10 months or 12 months, whatever is your choice. Now question comes, when I have to club these months, can I take January to June? Why this question arises? Because January to March is in previous financial year and April to June is in another financial year. Now, can I take the period falling in two different financial years? So for this, the law has allowed this and said that you can even file refund claims, which is involving period from different financial years. That is also allowed. Now, the next point is documentary evidence for filing a refund claim. The applicant need not file elaborate documents along with the application. Standardized and easy to understand documents have been prescribed. Now, what are they? That we will see. So what are the documents which you should file along with your refund application? So first, evidences which are prescribed so that you can establish that refund is due to you. So if you are a buyer, you have to upload the purchase invoice. If you are supplier, you have to export invoice, etc. Next, most important, you have to give a documentary proof that there is no unjust enrichment. We are going to discuss this point later in detail. So for that, you have to give the documentary proof. Most important, where the amount claimed as a refund is less than 2 lakhs, it is not necessary for applicant to furnish any documentary or other evidence, but may file a declaration based on the documentary or other evidence available with him, certifying that there is no unjust enrichment. Now, further documents are, in case where the refund is on account of some judgment decree, what you have to submit additionally, the reference number of the order and the copy of the order passed. That has to be filed. Next, in case of export of service, the reference number of the order and the copy of the order passed. That has to be filed. Next, in case of export of service, statement containing the number, date of invoice and the relevant bank realization certificate, that is BRC or FIRC. In case of export of goods other than electricity, the statement containing the number, date of shipping bills, bill of export and the number and date of relevant invoices. Further, the realization of convertible foreign exchange or Indian rupees wherever permitted by RBI is another condition for export of service, whereas in case of export of goods, realization is not a precondition. So consequently, the documentary evidence in the form of BIRC, FIRC is not required now. It may be required in future, but not at the time of application. However, in case there is non-realization of consideration as per the terms of EMA, then the exporter will have to refund back the amount which it had received as refund. In case you are exporting electricity, a statement containing number and date of export invoices, details of the energy exported, that is the units of energy, etc. Tariff per unit for export of electricity as per agreement. Copy of statement of scheduled energy for export electricity by generating plants, and copy of agreement detailing the tariff per unit. Next, whenever there is upward revision in price of goods after your actual export, then the document should be uploaded are number and date of export invoices, number and date of shipping bills, number and date of BIRC, FIRC in respect of such shipping bills, along with the copy of this, and the details of refund already sanctioned because you have already got refund on the original export. Now it is for upward revision, and the number and date of relevant supplementary invoices which you have issued. In case of supply of goods to SEZ, statement containing the number and date of invoices as provided in 46 along with evidence regarding goods admitted in full for authorized operation. Similarly, for supply of service to SEZ, statement containing number and date of invoices, evidence regarding receipt of service for authorized operations, which should be endorsed by the proper officer. Now, for both of this, a declaration to the effect that tax has not been collected from SEZ is also required to be given. In case of deemed export, statement containing the number and date of invoices, along with acknowledgement by the jurisdictional tax officer who is giving you the advance authorization or EPCG license, as the case may be, that the said deemed export supplies have been received by the said advance authorization or EPCG authorization holder, or a copy of tax invoice under which such supplies have been made. Undertaking by the recipient of deemed export supplies that no ITC has been availed, and undertaking by recipient of deemed export supplies that he shall not claim the refund. Refund of unutilized ITC accumulated on account of inverted duty structure, you have to file a statement containing number and date of invoices received and issued. In case of finalization of provisional assessment, reference number of final assessment. Tax wrongly collected and paid, statement showing details of transactions considered as intrastate supply but which becomes interstate supply. Excess payment of tax, statement showing details of amount of claim of excess payment. Agreement or contract for supply of services cancelled. So you paid tax in advance, but later on it was cancelled. Statement containing details of invoice numbers, date, value, tax paid details in respect of which refund is claimed. All these things have to be filed. Now, wherever your refund amount exceeds 2 lakhs, in that case, what you have to do, you have to also file a certificate in annexure 2 of RFD 01, which has to be taken from a chartered accountant or a cost accountant. So up to 2 lakhs, no need for this CA certificate, self-declaration sufficient. But beyond that, CA certificate. Further, declaration or certificate, both are not required in following cases. So in these cases, both things are not required. First, refund of tax paid on export of goods, services, or both used in making such exports. Refund of unutilized ITC in case of zero-rated supplies made without payment of tax, or in case of inverted duty structure. Refund of tax paid on supply which is not provided either wholly or partly, that is, it is cancelled. Refund of tax wherever you have paid the wrong tax, that is, instead of I you have paid C plus S or vice versa, and tax or interest borne by such other class of applicants which the government may notify. So this is that certificate which you have to submit. Now comes an interesting point. Manner of filing application for refund by unregistered person. Now this was introduced later on, where the government realized that like in case of a builder, you have booked a flat with a builder and later on for some reason you have to cancel that contract. Now if the builder can issue credit note, he will issue credit note and cancel the amount of tax. But where this is not possible for some reason and the builder is either unable or does not want to issue credit note, in such cases, the buyer may apply for refund. Now, the problem is that the buyer may be unregistered because the buyer is a home buyer and maybe doing it for personal use, maybe a salaried person and maybe unregistered. In this particular case, the challenge is how will the unregistered person make an application? So for this, there is a special facility which is introduced in the common portal, which allows unregistered person to take a temporary registration and apply for refund under the category of refund for unregistered person. So now this has been made available on the portal under a separate tab, and you have to only take a temporary registration for doing this. Further, it is provided that the certificate by a CA or CMA to the effect that there is no unjust enrichment is also not required in these cases where refund is by an unregistered person and the amount is claim is exceeding 2 lakhs. Now, what is the relevant date of this refund? So as we have seen earlier, the relevant date wherever the recipient files a refund application is the date of receipt of goods or service. Now, in the given case of refund, the date of issuance of letter of cancellation of contract by the supplier will be considered as the relevant date. Now comes the third point is procedure on receipt of refund claim. So you have made the refund claim. Now what is the procedure? Now where the application relates to claim of refund of cash ledger, an acknowledgement in prescribed form shall be made by the applicant, clearly indicating the date of filing of refund. In case of other refund claims, the application shall be forwarded to the proper officer. Proper officer will take 15 days to scrutinize the application. Now, where the application is found to be complete as per the rules, an acknowledgement in prescribed form will be given to the applicant through the common portal. Refund application clearly indicates the date of filing of refund. Now, in this, there could be deficiency. So, where deficiencies are noticed, the proper officer shall communicate to the deficiency in the deficiency memo, require him to file a fresh application after rectification of such deficiencies. Where deficiencies have been communicated to the application under SGST rules, the same shall also be deemed to have been communicated under the CGST rules. Now, withdrawal. It may happen that after filing of the refund application, the applicant may decide not to go ahead with refund. In such cases, anytime before issuance of the refund sanction order or final refund sanction order or payment of refund, then the applicant may withdraw the application. On submission of such withdrawal application, any amount which is debited to your electronic credit ledger or cash ledger will be recredited. Now, wherever you want refund, there is a provision for grant of refund, which says that GST law provides for grant of provisional refund of 90% of your total claim in respect of your zero rated supplies, and the provisional refund would be paid within 7 days after giving acknowledgement. Remaining 10% will be refunded after due verification. Now, detailed provisions are as under. So 54.6 states that proper officer may, in case of claim of refund on account of zero rated supplies by registered person other than such category of persons as may be notified, will provisionally refund 90% of the total amount. So in case of zero rated supplies, he will refund 90% of the total amount within 7 days. Provisional refund shall be granted subject to the condition that the person claiming refund has, during any period of 5 years preceding the tax period to which the refund relates, has not been prosecuted under the Act for an amount exceeding 2.5 crores. Then the proper officer, after scrutinizing the claim and the evidence submitted in support, and on being prima facie satisfied that the amount claimed is due to the applicant in accordance with 54.6, shall make an order in the prescribed form sanctioning the amount of refund due to the applicant on provisional basis within period not exceeding 7 days. Next, proper officer shall issue a payment order for the amount sanctioned, and the same shall be electronically credited to your bank account. However, the payment order shall be required to be revalidated where the refund has not been disbursed within the same financial year in which the said payment order was issued. Now, in this relation, students, there is an amendment. So let me take you to that amendment. So we just studied about provisional refund, which is to be granted within 7 days. Now, in this, there is an amendment. What it says, the proper officer on the basis of identification and evaluation authorized by the system shall make an order in the prescribed form sanctioning the amount of refund due to the application on provision basis within period not exceeding 7 days from the date of acknowledgement. The proper officer, for reason to be recorded in writing, may not grant the provisional refund and in that case proceed with the order. However, said order shall not be required to be revalidated by the proper officer. So this has been made effective from 1st of October 2025. Now, persons who shall not be allowed refund on provisional basis are first, the proper officer may, in case of any claim for refund on account of zero rated supply of goods or services or both, other than such category as may be notified, refund a provision 90% subject to conditions and safeguards, and thereafter make an order under 54(5) for final settlement. Now, any person who has not undergone Aadhaar authentication or who is engaged in supply of following items. So for these people, the provisional refund application or the provisional refund of 90% is not applicable. So student, basically the amendment is that if you see the original provisional refund of 90% was allowed only in case of zero rated supply. Now it has been extended to all refunds. So not only zero rated supply, all refunds are covered here. Second, the only restriction for provisional refund is one, in case of a person who has not undergone Aadhaar authentication, and second, who is engaged in supply of these items, that is acria nuts, pan masala, tobacco, and manufactured tobacco substitutes, and some essential oils. So for these products, provisional 90% refund is not applicable. Your refund has to undergo the detailed process, and only after proper scrutiny you will be allowed the refund. Now, order of refund. So 54(5) will be the final order of refund. After scrutinizing all documents and the proof that you have not passed on the duty burden, you will be given the final refund. Otherwise, if there is any problem, it will be created to Consumer Welfare Fund, which we are going to discuss later. Now, refund to be granted both in cash and credit based on original mode of payment. Now, this is very important. Wherever you have originally paid the tax using cash ledger, and this tax is now eligible for refund, the refund will come back in your cash ledger. That is, will be paid to you in money form. But where you have originally utilized the tax through your credit ledger and this refund becomes eligible, then that amount will come back to your credit ledger. So depending upon the mode of original payment, the refund of that tax paid will be granted. Where the proper officer is satisfied that the amount refundable under the Rule 92 is payable to applicant, instead of being credited to Consumer Welfare Fund, he will make an refund order in the prescribed form. Where the proper officer is satisfied that the amount refundable is not payable to the applicant, he will transfer the refund to the Consumer Welfare Fund. Now, the time limit for issuance of this refund order will be 60 days from the date of receipt of application, which is complete in all respects. The time limit of 60 days shall be counted from the date of filing of the refund claim, as mentioned on the acknowledgement given to you. Now, another possibility is issue of SCN and rejection of refund claim. So many times, instead of giving you a deficiency memo, the officer will issue you SCN. In this SCN, the officer may raise various queries and may seek your clarification. Once you respond to this SCN and the officer is satisfied with your reply and all your queries are replied by the officer, he will allow that SCN and give you the refund. If not, if you are not able to satisfy or respond to the query of the officer, your refund application will be rejected. The applicant will be required to make the reply within 15 days of receiving the SCN, and after considering the reply and giving an opportunity of being heard, the officer will have to take the final call. Importantly, there is also provision of withholding of refund. So despite of you being eligible for refund, the officer may withhold your refund if there is an order which is giving rise to refund is subject matter of appeal or further proceedings, or where any other proceedings is pending and the commissioner is of the opinion that the grant of refund will adversely affect the revenue. So either the refund order is under challenge or there is some other pending proceedings, your refund which is otherwise sanctioned may be withheld. Fine. Now, credit of the rejected amount. Now, wherever your refund amount is rejected, what will happen? At the time when you made the application for refund, you had debited your credit ledger or you debited your cash ledger. Now, in case your refund is rejected, the amount will come back. It will be recredited to that particular respective ledger. For the purpose of this rule, the refund shall be deemed to be rejected if the appeal is finally rejected or the claimant gives an undertaking in writing to the proper officer that he will not file an appeal. Now, students, we come to a very important principle, which is principle of unjust enrichment. So whenever there is refund, this particular provision, which is coming right from the excise era, arising from a very famous judgment of Mafatlal Industries, this judgment has been, this particular provision arising from this judgment has been continued in the GST law as well. Now, what is the concept? What is the principle of this unjust enrichment? So, as we all know, GST is an indirect tax. And generally in indirect tax, what happens is the supplier passes on the burden of tax on the buyer. So let us say I have sold some goods to you. I have levied some tax. Later on, it is found that this tax was excess because these goods were eligible for exemption. Now, obviously, in this case, refund is available. Yes. But the question is, who should get the refund? The simple answer is refund should be given to the person who has borne the tax burden. Now, if even though as a supplier, I went and paid the tax to the government because that was my responsibility, but I had charged the tax and collected the tax from the buyer and that I have paid to the government. Now, since I have collected the money from the buyer and paid to the government, if this money is refundable, it cannot be refunded to me. If it is refunded to me, it will be an unfair advantage to me because originally I had not paid this tax. I had not paid this tax means I had not borne the tax burden because I had collected this from the buyer and the buyer's money I paid to the government. So if now refund is available, the refund should be given to the buyer, that is a person who has borne the tax incidence. If this refund is given to me, who has not borne the tax burden, it would be unjust enrichment to me, which is unfair. And that is where this principle comes in. So, this theory of unjust enrichment requires that only the person who has borne the tax incidence, who has not passed in further, is eligible. Where the amount of tax has been recovered from recipient, it shall be deemed that the incidence has been passed on to the recipient. Under unjust enrichment, a presumption is always drawn that the businessman will shift the incidence to the final consumer. We all know this is the assumption. This is because GST is indirect tax whose incidence is to be borne by the consumer. It is for this reason that every refund, if sanctioned, is first transferred to the consumer welfare fund. Because we presume that ultimately it is borne by the consumer or the recipient. Now, in what cases this theory of unjust enrichment will not apply? That is, the refund will be given to the applicant. So, they have made a list that in these cases, the refund will not be transferred to the consumer welfare fund, but will be given to the applicant. First, where the amount relates to refund of tax, which is paid on export of goods or services, or on inputs which are used in making such exports. So students, as you all know, whenever you are making an export, you are supplying to a foreign person, and practically a foreign person will never pay the taxes of India to you. Hence, it is a very safe assumption that you have not passed on the duty incidence, and therefore we are giving you the refund. Second, refund of unutilized ITC in case of zero rated supplies made without payment of tax or accumulated ITC under inverted duty structure. So again, in this case, since on your outward supply itself you have not charged the tax, you are claiming refund of your accumulated ITC. Refund will be given to you because ITC is the tax which you have paid from your pocket. Next, where the refund of tax paid on supply which is not provided either wholly or partly, and for which invoice has not been issued. Now, since you have not issued an invoice, you may not have collected the tax. But if you have collected the tax on advance, you should have issued a refund voucher through which you are refunding back the money. So if you have refunded back the money to the buyer, then the refund will be given to you. Next, refund of tax in percents of 77. So you have paid a wrong tax. Instead of C plus S, you have paid I or vice versa. Next, tax or interest or any amount paid by the applicant if he has not passed on the incident. So this is where the recipient is coming and taking the refund. And last is tax or interest borne by such class of applicant which the government may mention. Now, disbursement of refund of state tax. So the answer is the government may disburse the refund of state tax in such manner as may be prescribed. Refundable amount to be credited to consumer welfare fund in all other cases. So in all the cases except the above, where refund is not allowable to you now, so it will go to the consumer welfare fund. Importantly, student, the amount of refund cannot be even retained by the government, because once it is established, this amount is refundable. And if it is not refundable to you because you have passed on the duty burden, the government also cannot keep the amount because it will be again unjust enrichment in the hands of government. So in such cases, like how you cannot get the refund, the government also cannot keep the refund. So it has to be transferred to the consumer welfare fund. Now we come to provisions relating to refund of unutilized ITC. Now, what are the situations where your ITC is unutilized, or it is also called as accumulation of ITC? So one, where you are exporting goods services without charging IGST. Two, you are supplying to SEZ without charging ITC, or you are covered under the inverted duty structure. Now, what is an inverted duty structure? So inverted duty structure is a situation where the rate of tax on your input side is higher than the rate of tax on your output side. In such cases, it will be considered as a inverted duty structure. Now, what is very important is if your output is nil rated or fully exempt, it is not eligible for inverted duty structure refund. Next, suppliers who supplies goods to merchant exporter at the concession rate of 0.1%. In such cases, the supplier's output is at 0.1, but the input is at normal rate. Again, this is covered in the inverted duty structure. Now, supply of specified goods services. Refund of unutilized ITC on inverted duty structure is not allowed. So the government, on recommendation of the council, have notified supplies of certain goods where no refund of unutilized ITC on account of inverted duty structure is allowed. What are those cases? First is the case of construction. So a builder who is doing construction of complex, in that particular case, the builder will not be eligible for claiming the inverted duty structure refund. Further, wherever you are engaged in supply of rail locomotives powered from an external source of electricity or by electric accumulators, or you are in supply of soya bean oil, olive oil, palm oil, coal, lignite, etc. It is clarified that this restriction on refund of unutilized ITC paid on inputs is not applicable in case of zero rated supply of specified goods or services. So above restriction is only when you are trying to claim refund of domestic supplies which are under inverted duty structure. If the above supplies you do export, refund will be eligible. So refund is only restricted for IDS, not for zero rated. Again here, for this refund, you have to make application in RFD 01. Same, the time limit is 2 years from the relevant date. Again, the doctrine of unjust enrichment you have to check. Now, importantly, since you are claiming refund of your inward supplies of your ITC, which is accumulated, this doctrine will automatically fail because the inward side tax you only have paid. So you are very much entitled to take the refund. Now, the amount to be claimed as refund, 89.4 stipulates that in case of zero rated supplies of goods or service or both, without payment of tax, that is under bond or LUT, the refund is allowed as per this formula. Now, this is, students, a simple logical formula. Your refund amount is given to you proportionate. Proportionate of what? So, how much of your outward supply is zero rated divided by what is your total turnover. So, it may happen that out of 100 rupees of total turnover, 60 is export, 40 is domestic. Now, we are allowing refund only for export. So, in the numerator, it will be 60, denominator, it will be 100. So, this will give you the proportion. This proportion is multiplied by net ITC. So that is how you'll get the proportionate refund of your ITC, which is applicable towards the export. Correct. Now there are some, you can say, inbuilt restrictions and conditions. So the turnover which you are taking in the numerator for zero rated supply of goods will mean the value of zero rated supply of goods made during the relevant period on which you have not charged GST, or value which is 1.5 times the value of same goods which you have supplied domestically, whichever is less. Similarly, for a turnover of zero rated supply of services means the value of zero rated supply of services made without payment of tax under LUT or bond, and it is calculated in the following manner. So the manner is simple. You'll have to identify what is the value of zero rated supply of services where you have received payment in advance, then the amount which you have received in advance, or where the invoice is given and payment is not received, then the amount mentioned in the invoice. In denominator, you take the adjusted total turnover. So adjusted total turnover, student, means your total turnover, excluding the value of exempt supplies other than zero rated supplies. Now, what is the relevant period? The relevant period means the period for which you are filing the refund claim. Now, there are some clarifications regarding the manner of calculating the adjusted turnover. So these are some specific situations where the denominator, which is the adjusted turnover, has to be calculated. So first clarification is, as we saw in the numerator, while calculating value of exported goods, we had a restriction of 1.5 times. So whatever is the restriction on the numerator, the same restriction will be applicable on the denominator. In short, so in numerator, whatever value you have taken for export, the same value will be taken in the denominator. So it will not happen that in numerator you have taken a different value and denominator a different value. Next, where the restriction of turnover of zero rated supply of 1.5 times is applicable. So again, the denominator will be calculated in the same manner, taking that 1.5 times. So it is clarified that the same value of zero rated supply of goods as calculated as per the definition of zero rated supply of goods need to be taken into consideration when you are calculating the denominator. So in short, numerator, denominator will be calculated in the similar manner. Next student, comes the formula for refund in case of inverted duty structure. Now again, this formula initially may appear to be slightly technical. Maybe people will feel it is drafted like a science formula, but that is not the case. Understand the logic. So again, first in the numerator, you have the value of inverted duty structure supply. Denominator, you have total value. So again, we are taking the proportion of what is your turnover of zero rated supply upon total turnover. So again, same example, 100 rupees turnover, out of which 60 was export. In balance 14, 25 is inverted duty structure. So numerator will be 25, denominator will be 100, right? Minus tax payable on such inverted duty supply multiplied by net ITC upon ITC availed on inputs and input services. So basically, now what is happening inside this bracket is, now since this is an inverted duty structure, you have already paid some tax on this inverted duty supply. So that tax, I will not give you refund because that is already your liability. So that tax multiplied by the net ITC upon ITC availed on input service will be taken as your final formula in the inward side. And this formula, when applied, will give you your final refund amount. Now here there is a clarification relating to inverted duty structure refund. What is the inverted duty structure refund clarification? So it may happen that there is a change in rate. Like if you remember last year on 22nd September, the government announced some significant rate change. Now before the rate change, your goods were 18%. After the rate change, it has become 5%. Now, whether this scenario falls under inverted duty structure. So the answer is where your supplies are attracting different rates at different point of time, it is not covered under 54 bracket 3, that it will not be covered under the inverted duty structure. So inverted duty structure means where the rate remains constant of your input and output, and then there is an inversion. But if because of change in rate there is an inversion, that is at the time of purchase the rate was high, but at the time of sale the rate is low, we will not treat it as inverted duty. Next, in case of merchant export, where they are going for that concessional notification of 0.1%, they are very much eligible to be covered under the inverted duty structure refund. Next, refund of ITC under 54.3 is restricted to the extent of invoice details as are reflected in 2B. Now, you all know, students, now GSTR 2B has become the main deciding point even for your ITC availability and even for the refund eligibility. So in refund, since we are allowing you refund of net ITC only, so ITC will be calculated on the basis of what is appearing in your 2B. So determination of refundable amount in case of refund of unutilized ITC on account of export without payment, supplies to SEZ without payment, and accumulation on account of inverted duty structure. So this is the formula which we have studied earlier. So what is given over here? After calculating, the list of the three amounts will be allowed. What are the three amounts? First, amount as per the formula. Second, the balance in your electronic credit ledger at the end of the tax period, and the balance in the electronic credit ledger at the time of filing refund application. So logically, whatever amount you get from the formula, that much amount should be there in your credit ledger. So we are taking list of three. So if in your credit ledger you have less amount, you will be given lesser refund. Now, after calculating the list of three, as detailed above, the equivalent amount is to be debited from your electronic credit ledger. So how now you will utilize the amount for refund? First, you will utilize your ITC balance. Second, central tax and state tax equally to be to the extent of balance available, and in the event of shortfall in the balance available in a particular credit ledger, the differential amount is to be debited from the other credit ledger. Cases where refund of ITC is not allowed. So there are certain cases where your ITC refund will be blocked, and that case is where your goods are subjected to export duty. Now, what is the meaning of goods subjected to export duty? It means there is some export duty applicable on your goods and you are paying that export duty. So whenever you are paying export duty, then those goods will not be entitled to get refund of ITC accumulation. Now here there is a clarification. So what if your goods are mentioned in the second schedule of the Customs Tariff Act? Now second schedule, students, of the Customs Tariff Act is for export. Now the question is, your goods are mentioned in the second schedule, but the rate given is nil, or there is some rate which is fully exempted through some notification. Now in such cases, where either the rate given in the export schedule is nil or the rate is fully exempted, whether in such cases also it will be said that your goods are leviable to export duty and hence you will not get the refund. So for this, the clarification is given that such goods would not be covered by the restriction imposed in the second proviso, and hence they will be entitled to get the refund of accumulated ITC. Only those goods where actually you are paying some export duty, only for those goods there will be restriction and you will not get the ITC accumulated as refund. Second restriction where you will not be allowed the ITC is, so the refund of ITC will not be allowed if the supplier of goods or services has availed drawback in respect of the CGST or the IGST portion. So where in the customs you are allowed drawback of the same tax for which you are claiming refund here. So double benefit cannot be allowed. So if you have taken refund of the same CGST, SGST, IGST in your customs, why should I allow the refund over here? So you take drawback over there, no benefit over here. Next, no refund will be allowed if the value is less than 1000. Now, students, this condition has been relaxed. You will get that in the future as an amendment. Next, refund in case of goods or services exported outside India. So we have seen that wherever you are exporting goods outside India or services outside India, you are given two options. One is with payment, without payment. However, for with payment, there will be certain notified class of persons who will only be allowed the option of with payment, others may not be allowed. So refund of on account of export of goods with payment. So this we have already seen. The most important point, wherever you are doing with payment of tax export, you need not file a separate application under RFD 01. Watch what we were doing for claiming refund of accumulated ITC. Here, your shipping bill or the bill of export itself act as an application. So the moment you upload all your returns, the returns are automatically directed to the ICEGate portal, and from the ICEGate portal, once the confirmation is done, you get the refund. Again, the same condition, the applicant should have undergone Aadhaar authentication, then only the refund will be allowed. Otherwise, the refund is not allowed. Processing. Upon receipt of the information regarding the furnishing of valid returns under 3B from the common portal, the ICEGate system, the proper officer of the custom will process the refund. So here in case of tax paid exports, the proper officer of customs is the one who is processing the refund. Withholding of refund. The claim of refund shall be withheld when a request has been received from the jurisdictional commissioner to withhold a refund, or the proper officer of customs determines that the goods exported are in violation of customs law, or the commissioner in board or officer authorized by the board on the basis of data analytics and risk parameter is of the opinion that verification of the credential of the exporter, including the availment of ITC, is in the interest of the revenue. So in these cases, the refund may be blocked. Next, refund to the government of Bhutan on export to Bhutan. So where the central government has to pay refund of the IGST to the government of Bhutan in case of export to Bhutan for such class of goods as may be notified. Where such refund is paid to the government of Bhutan, the exporter will not be paid the refund. So obviously, if the government has already paid that amount to government of Bhutan, you cannot get the refund of the same amount. Next, clarification on whether refund claim can be preferred in respect of specified goods sent or taken out of India but not brought back. So the activity of sending or taking specified goods out of India is not zero-rated supply. That being the case, the sender of the goods cannot prefer refund claim where the specified goods are taken out of India. Now, further, the supply would be deemed to have been taken place on the date of expiry of 6 months from the date of removal if the specified goods are neither sold nor brought back within the said period, and on the date of sale in respect of such quantity of goods which have been sold abroad. So what is the point, students? Many times you send the goods which are sent on sale or approval basis. Now, sending on sale or approval is not equivalent to supply. So supply will be considered only if you get a confirmation within 6 months. So whatever is a confirmation received, that will only be considered as supply and eligible for a refund. Next, refund of ITC on export of goods or service under bond or letter of undertaking. This, students, we have already seen about in detail. Now, clarification in respect of admissibility of refund where an exporter applies for subsequent refund to the compliance of the provisions of Sub-Rule 1 of 96A. So where the goods are not exported outside India. So if you are not able to export the goods up to 3 months from the date of invoice, then in such cases, you will have to return back the amount of refund. Further, where in case of export of services, you are not able to receive the payment in convertible foreign exchange, again in such cases, the refund will not be allowed to you because these are the basic conditions subject to which the refund has been made available. Next, recovery of refund of unutilized input tax credit or IGST paid on export of goods where export proceeds are not realized within the stipulated time. Now, students, here you should know the stipulated time means the time as prescribed by FEMA. So, FEMA has prescribed a time within which the payment towards goods should have been received. Now, we will first allow you refund of goods on the basis of application, but in future, if you are not able to produce the proof of realization of export proceeds, then the refund which was allowed to you is to be refunded back. It will be recovered from you by sending you a notice under 73, 74 or 74A. Then comes the next category, refund of taxes wrongly collected and paid. So this we have seen earlier also that wherever you have levied a wrong tax, C plus S instead of I or I instead of C plus S, then there is a provision that you pay the amount of correct tax and apply for the refund of wrong tax. Now the question is, what is the time limit? The time limit is 2 years. 2 years from which date? 2 years from the date when you have paid the correct tax. So if let us say the transaction is 5 years old, but today it is realized that you have paid wrong tax, then today you paid the correct tax and the wrong tax you can get refund from today within 2 years by making an application. Next is the special refund given to United Nations bodies or embassies. So students, you would be knowing that these bodies, when they register, they are given UIN, a special unique identity number and not the GSTIN. And as per section 55, they can claim refund of taxes, whatever they have paid on all their inward supplies. So since they are United Nations bodies, they are given this special privilege. Now, who is entitled to refund under this section 55? So it is a specialized agency of the United Nations organization, multilateral financial institution organization notified under United Nations Act, consulate or embassy of foreign countries or any other notified persons. Who are these notified persons? United Nations or a special international organization, foreign diplomatic mission, consular post in India or diplomatic agents or career consular office posted therein. So students, these are the bodies who are covered under 55 refund, right? I'm just skipping the procedure for this for the paucity of time. Then comes interest on delayed refunds. So wherever you are not refunded the amount within 60 days, the interest will start. The interest has to be paid at the rate of 6% per annum. Interest on amount refundable consequent on an order or appeal. So where there is an order or appeal and the amount is not refunded within 60 days, then the interest payable is at the rate of 9% instead of 6%. Order sanctioning interest on delayed refund. So as per Rule 94, when any interest is due and payable to the applicant under 54, the officer shall make an order along with a payment order in the prescribed form. Such order shall specify the amount of refund, period of delay, and the amount of interest. And then students, the last point is consumer welfare fund. So we all earlier saw that wherever the tax is not refundable to you, it will be credited to the consumer welfare fund. And then the amount which is credited or paid to the consumer welfare fund, all this amount will be utilized for the benefit of the consumer education and protection. And last is refund of integrated tax paid by a tourist. So whenever a tourist has come to India and the tourist make any purchasing from any Indian shop, the tourist has to show his foreign visa, and on that basis, the Indian shop will issue an invoice to the tourist, and whatever tax the tourist has paid, that tax will be refunded back to the tourist at the time of its leaving India, where at the port or airport, it will show to the custom authorities the invoice and the goods which the tourist had purchased, and that it is taking these goods out of India after being satisfied as per the provisions of customs, sorry, as per the provisions of the IGST Act, the tourist will be entitled to claim the refund. So students, this is all about this chapter of refund. So I'm sure since we covered the chapter in complete detail, you would have understood every part of it. So kindly do revise at your end because this chapter was slightly procedural, slightly technical. So do revise it at your end. And in case there are any queries, you can put it across to us. So thank you, students. Thank you for today. Catch you up again in the next class for further topics for revision. Good day, everyone. Yes, Ashok ji. Good day.